Hello everyone. In this video we're going to be looking at Chapter 9, and in Chapter 9 we're going to be talking about inventory and merchandising transactions. So as you can see, there's quite a few different concepts to discuss in this chapter related to merchandising businesses and inventory, etc. So let's dive in. We've talked earlier in the course about different types of businesses, but as a reminder, a merchandising business is one that buys and sells products. You might think of these as you might have heard the term retail business before. It's differentiated from a manufacturing business who creates the products, actually builds them, manufactures them that they sell. And also service provider businesses where they're just providing a service like a lawyer or an accountant, etc. And one of the biggest differences that we need to look at when we're talking about merchandising businesses, and especially compared to a service company, is that the merchandising business is now going to have an asset. It sells inventory, and so now we're going to have inventory on our balance sheet that we hold on to for the purposes of selling it to make a profit, and that's what kind of makes the business a merchandising business, essentially. So here's just a little diagram. When we're talking about a service company, this business performs services, accounts receivable, receives cash, and that's the whole cycle. With the merchandising company here, we've got inventory that we purchase, then we sell the inventory to the customer, receive the cash, and that just continues on. So the big differentiator being that we have products that we're selling, inventory. We have a new account. In addition, inventory is a new account that we're looking at, and that's an asset. You'll see that on the balance sheet. But then we're also going to consider this new expense account called cost of goods sold. And cost of goods sold is going to be basically the expense that represents the amount that we had to pay to purchase our products in order to sell them. So if we are going to sell, say it's it could be a gas station, for example, and they're selling something for $10, some product, maybe they had to pay $5 to buy that product in the first place. So $5 would be the cost of goods sold. The sales revenue would be $10, like I mentioned, if it's a $10 item to sell to the customer. And so with the cost of goods sold being $5, this is the actual sales revenue to the customer being $10, then the gas station or the business, whatever it is going to make a gross profit, which is the difference between the revenue and the cost of goods sold, of $5. If we're assuming in our example it was $10 sold to the customer, it costs $5 to purchase it, so the business makes a gross profit of $5 in that instance. So I guess I could have clicked through. Here's an example. So as you can see, they're talking in their example about a business purchasing t-shirts for $5, sells them for $7, and then we also have various operating expenses totaling $700. So these are the kind of expenses we've talked about throughout the whole book. The course so far: travel expense, business cards expense, flyers, etc. And those operating expenses show up in a different place here. This is kind of a little snippet of an income statement. And you can see here that if we sold 200 t-shirts at $7 a piece, we would earn $1,400. We had to pay $1,000 to buy those shirts in the first place, $5 times 200. So we have a gross profit of $400. So we might be thinking, oh, cool, we actually made a profit. That's great. But if we account for the fact that we had $700 in operating expenses, you can see that we have a net loss here of $300. So that's not ideal. Here's an example of just changing the numbers a bit. So you can see if we sell 350 shirts, we're breaking even essentially. If we sell 500, we're making a profit. So This is just further example of showing you how the revenue, how gross profit is calculated, and just some context there. Okay, true or false, when a product is sold, the gross profit on the sale is precisely equal to sales revenue, and that's not true. That's the gross profit would be your sales revenue minus the cost of goods sold. Okay, now we're going to talk a little bit about inventory and inventory systems, how we track the inventory and do the inventory accounting. And there's two different kinds of methods here that we talk about in this text. There's the perpetual inventory system and the periodic inventory system. The perpetual system, if you know what the word perpetual means, it's ongoing essentially. And so what we're indicating with that word and what this perpetual system does in essence is that we record the cost of goods sold and update the inventory levels after every purchase and sale. So this is really an ideal system where every time there's a sale, the accounting records behind the scenes are being automatically updated essentially. Contrast that with a periodic inventory system. This would be more for companies here that do not keep a detailed inventory records, and instead the way that this type of business would figure out what is our cost of goods sold is that we would have to go at the end of the accounting period, for example, and do some analysis, look at our inventory levels, and we would come up with a cost of goods sold just based on that one-time inventory count at the end of the period. And as you can imagine, it's much more ideal to have an ongoing updated system, and the periodic system is really just because the company doesn't have the ability, operationally to keep those detailed records, and so it's kind of a necessity to use this system. But a more up-to-date system, timely information is ideal. So in most circumstances, you would rather have a perpetual system that's automatically updated. And when we do our book problems, I believe that almost all of them are kind of from the perspective and viewpoint of a perpetual system. We don't talk in the homework problems or exam problems that much about the periodic system necessarily. But these are two systems, so we do spend the time to kind of show you that. So here's an example. If we have of the differences here, if we had a perpetual system and we're doing monthly financial statements versus a periodic where we only update every 3 months, essentially, we wait until the end of March, you can see that every month we would know our gross profit, we would know our cost of goods sold, we would also know our inventory levels better. In the periodic, we have to wait until the end of the quarter to do a physical count of inventory, and then we learn what our gross profit was. So you can really see you'd have to wait 3 months to know your gross profit. That's definitely not ideal versus continual, or I should say perpetual updating of the system as you go. Okay, so true or false, a perpetual inventory system continually tracks changes in inventory and matches cost of goods sold to revenue as the sale is generated. That is true. That's kind of the hallmark of the perpetual system and why it's a valuable system to have in place, because it's more timely. But the downside is, an inventory system being more costly, it does take technology and systems to be able to do that perpetual tracking, as opposed to just going out and doing a physical inventory count once every quarter, for example. So it's a cost benefit situation, and each business will have to kind of analyze their capabilities themselves to determine which system to implement. But as we've seen, the perpetual system is the one that a business would most likely want to have because it gives you timely information. Okay, let's talk a little more about the perpetual inventory system, and specifically looking at the kinds of journal entries and whatnot that we will be learning about under the perpetual system. And so, as we've been discussing, we're going to update the records every time there's a purchase or a sale. And remember that we're talking about some new accounts here in this chapter. We have inventory, which is an asset. We have cost of goods sold, which is an expense. And so and just a note, you'll see merchandise inventory with the text. So if I say inventory, I mean the same thing as merchandise inventory, just interchangeable terms basically. Okay, so let's look at an example of purchasing some inventory. So for example, here we have this company purchase some inventory on January 1st. Yeah, so nothing too unique here or new. It's just like buying any other asset that, on account. We're using accounts payable. So that indicates that we haven't, paid the cash yet, but we will in the future. But we have an asset increasing and a liability here. So a very kind of basic type of journal entry, but we just have this new asset of inventory that we are accounting for. Okay, so our example here, problem says, suppose inventory worth $7,200 is sold for $15,000 on account. The sale of inventory is recorded using 2 journal entries. And so you'll see this kind of 4-line, so you got 1 line, 2 line, 3 line, 4 lines. So sometimes these journal entries are combined into 1 entry, but here in our text, they kind of break them out into 2 separate entries. These 2 entries here are occurring simultaneously, so that's why they could be grouped into 1, because they're happening at the same time, and they basically are 2 parts of the same transaction, a sale, right? Breaking them out makes it a little clearer exactly which part is which, but you might see it either way in the future at different points. So keep that in mind. But one way or the other, there's going to be 4 different lines for these journal entries. You're going to have the sales part. As it mentions, we sold this for $15,000. So again, basic type of journal entry. We have revenue going up. We have accounts receivable increasing. So this is the customer owing us $15,000. And then down here, we have this inventory that we purchased for $7,200. And so now our inventory asset is going away. It's going down to 0 because we sold it. We don't have that inventory anymore. And we're increasing our cost of goods sold expense here for the same amount. And to find our gross profit, then we just take the $15,000 minus the $7,200. So if we were curious on what the gross profit was going to be, then it would be whatever the difference. I think that's $77,800. So that's a typical purchase and a sale. We also have returns that can happen. And so when we're accounting for a returned product, we're basically just going to do a reverse of that. I'm sorry. Let me make sure because there's returns that can come from the customer. This return is a purchase return, not a sales return. So a purchase return is going to be us returning the product to the vendor. So here we are as the business. We got the goods in. Notice some of them were damaged. And so, if we see a portion of them being damaged, here it tells us, that portion was $500 worth of the inventory. And so we're returning this inventory. And so we basically just reverse that original transaction that we had. Go back to here. This was, for example, a normal, purchase transaction, asset up, liability up. But then if we review it and say, oh, now there's a part we don't want to accept this damaged goods, so we just reverse that original transaction for and use the dollar amount that we're sending back, because we're not going to pay this liability anymore, and we're not going to have that inventory. And so we just send the stuff back and do this reversal to update our accounts payable and inventory to the correct amounts to account for that return. Okay, let's talk about purchase allowances. So here's an example here that tells us we have another $500 worth of unsatisfactory goods, and the supplier offered us an allowance for the company to keep the goods rather than returning them. So in this instance, if we say, we reach out to our vendor and we say, hey, 500, this portion of these this inventory that we bought from you is something's subpar, something's wrong with it. Maybe it's not completely damaged and unsellable, but it's scuffed up or whatever. And so the supplier says, okay, well, in order to just hopefully you guys keep it, we'll keep a good relations going. It's probably easier on the vendor not to have to get this returned and restock it and resell it. So they offer a 20% allowance. So then we just reduce the amount of our accounts payable by that discount amount. In this instance, it was 20%. So we just would say, okay, 500 times 20%. So contrast that with sending the whole thing back. We're reversing that entry for the full amount of the purchase, and versus the discount, we're same journal entry, we're reversing that original purchase, but just for the discounted portion. And again, you just have to calculate that based on the instructions in that problem. Okay. We also have some concepts here to learn about. The first being purchase discounts, and one of those being a cash discount. And the idea here is that the vendors, say they're selling us products, they want to get paid sooner, right? So we have this concept of accounts payable, and we as the seller, we have accounts receivable, and we use those accounts to represent the fact that we are selling and buying things that will be paid for or will receive the cash in the future. And typically, generally speaking, in almost all instances, you want to get that cash as soon as possible, right? You might want to wait to make your payment so you could have more cash on hand for whatever reason. You may be having that invested or something, but the seller of a product, for example, would like to be paid as fast as possible. So what is commonly done is that they will offer a discount off of the full amount of payment if they are paid sooner. So you'll see this kind of information written like this here, and what this means, you can see here, it's read as 210 net 30. And what that means here, as it notes, is that if the buyer will pay the seller within 10 days, the seller will give the buyer a 2% discount. And the net 30 means you have to pay us within 30 days. But this is the important one to remember for purposes of transactions and test problems and homework problems, etc. Is just that if as long as the payment's made within 10 days, the buyer can take a 2% discount and pay a little bit less than they would otherwise. Okay, let's look at an example here. So we'll assume that Tools for You, our company, let's see, made a payment on January 10th. The amount for the bill is $9,400 minus $188 discount. Okay, so they're just telling us, we didn't have to do the calculation here necessarily, but we will practice that and learn it in the future. But the way that the journal entry looks when you calculate, as long as, step one when you're doing these problems, you have to, figure out, is there a discount? In other words, is the payment being made within those, whatever that time period is, 10 days in this instance. And so, in this example, it is, the bill was $9,400. We are paying within the discount period, so then we just multiply the discount amount of 2% times 9,400 gives us 188. And then we go in here and we do the journal entry. And the journal entry, the accounts payable side, that just goes away. We reduce accounts payable for the full amount because we're no longer going to owe that to the seller. So that's just a normal reduction, in liability based on a payment. The difference is that the cash amount that will be paid doesn't have to be the full amount of the AP reduction, which is typically that's what we see, right? When you have a liability being reduced with a payment, those are going to be the same amounts because that's just, paying something off with cash, reducing the liability. But in this instance, since we're paying quickly, the seller says you don't have to pay us the full $9,400. You can pay us $9,212, which is basically 98% of the full value, with the other 2% being down here with a credit. And this is just a representation to show that we've paid less, right? And the way the account that we credit is merchandise inventory. And so why do we use merchandise inventory? Remember, that's an asset, essentially. It's not that we're sending inventory back to the seller or anything. It's just that the value of the inventory on our balance sheet is now going to be a little less. So it's not going to be 9,400 necessarily. It's going to be 9,212 essentially. So the value of the inventory on our balance sheet as an asset will always represent the full amount that we paid for it, or I guess I should say the actual amount that we paid for it, inclusive of a discount if that is received because of a quick payment, essentially. Okay. Now here's an alternative example if we don't pay within the 10 days. So that, as I said, the first step is just to figure out if you get the discount. If you don't get the discount, you're paying it beyond that 10-day discount period. Then it's just a normal accounts payable goes down, cash goes down. Inventory has no effect on the amount. It still is 9,400. And so that's just kind of the typical journal entry that we've learned about so far. So no difference there if we don't get the discount. Okay, one item to consider as well is the concept of freight. And you can think of freight as shipping, the cost incurred for shipping. If you think about, a merchandiser, they have to get those products in before they can sell them to the eventual buyer. And so we could be having to pay for freight, that could be railroad companies, could be airplanes, trucking companies. I mean, in our global world today, there's a lot of shipping happening around the clock, basically, right? And as a merchandiser, in order to get the products to us so that we can sell them to our customers, we're going to have to incur some expense of buying those products originally from, the manufacturer, for example. And to get the things to us, to get the products to us, there is cost associated with that. Now, who pays that cost of shipping the products to the retailer kind of depends on the specific arrangement. And there's some terms here that we'll learn. The first being FOB. So FOB, let's talk about that first. It means free on board. And when we say FOB, shipping point, what we mean with this terminology is that the ownership of that inventory changes from the manufacturer to the merchandiser at the shipping point, essentially. In other words, if anything happens to the items while they're being transported, the buyer is the one who owns them at that point. They bear the risk of the loss. They probably have to have some insurance in place just in case something happened there. In this instance, so the buyer buys the products. They own those products when at the time that they leave the seller's shipping, location, essentially. And so in that instance, the buyer of the products owns those products right as they leave the warehouse of the manufacturer, and the buyer, us, the merchandiser in this instance, pays for the shipping costs. And like I mentioned, we would want to have some insurance on those items because we own them now. And if UPS or whoever's shipping them to you loses them or damages them, that inventory somehow, we would be the ones who would be out of luck, as the buyers, because it's FOB shipping point. And we've got a little example here. So if we have the FOB shipping point, and again, this is just a contractual agreement. It depends on the circumstances of the individual business relationship, basically. But here it'll always tell you in the instructions of a problem. So we bought some inventory from a manufacturer, for example. It's FOB shipping point, and that means that we have to pay the cost of the shipping. Let's suppose the shipping charges were $100 and it was paid in cash. So that's the totality of the whole thing. So what we want to do with those costs is, you might initially think, we want to record freight expense or shipping expense or something like that. But when we're talking about inventory, what we really want to do is capture all of the costs that we had to pay to get that inventory into our hands in a sellable manner, so that when we price those products and record our gross profit, that those costs of us getting the inventory, and not just the cost of the inventory, but also the costs of shipping the inventory to us, are basically a part of the inventory. So if we have one, let's just assume we had one item of inventory shipped to us, and it was $10,000 to purchase it, for example, and then we paid $100 for shipping, and we're the merchandiser, so we're buying this from the manufacturer, for example. That inventory would sit on our balance sheet at $10,100. Even though we only paid $10,000 for the actual item from the manufacturer, we include the cost of the shipping as a cost of the inventory as well, basically, so that we're capturing all the costs of us getting the inventory to us and in a sellable, state, essentially. So just remember that it goes in, it's not shipping expense when it comes to us. It's actually an increase to an asset. So asset down and the inventory asset goes up. Okay, now we're going to contrast the FOB shipping point with the concept of the FOB destination. So this kind of changes the structure of the contractual agreement, and it changes the ownership timing. When we say destination, that means that the seller, the manufacturer in this instance, they're going to own that inventory until it arrives at our location, until we receive the inventory at the shipping destination, basically, right? And in this instance, if we have this as a part of our contract for purchase, that means that if something goes wrong if the inventory is damaged or lost while it's being shipped, that means the seller, the manufacturer, is the one who would have to incur that loss, because the ownership only changes when it arrives to our factory warehouse or wherever it is at our store location, basically. And in this instance, the seller then is going to be responsible for paying for the shipping costs. And like I said, the sellers may, at that point, be the ones responsible for paying for insurance as well, just to, if something does happen, that they don't have to incur that expense. So in this instance, we're going to say, our company. So we are the ones shipping the inventory now. Think about that. So the previous example was tools for you, us buying the inventory. Now we're selling the inventory and shipping it out, and it's FOB destination. And so in that instance, we are paying the expense to ship the inventory out. And so when it's that outgoing shipping, not incoming, remember the incoming, we're going to debit inventory, the asset. But when we're shipping out, we're going to debit the expense, and that's just going to be delivery expense. So it's just a cost of doing business, basically. So that's the two primary differences there. And here's a breakdown of kind of what we were just talking about. Risk of loss, who bears that risk, the costs, who pays it, and all those kind of things. So hopefully that's relatively clear. It is built into the title, the shipping point. You can kind of understand, okay, the ownership changes hands, at when the items are placed on the shipping, and then the destination is the ownership changes hands when it arrives at the buyer's location. Okie dokie. So we looked at this already basically, but we'll review this again. The sale of inventory is that same 4-line journal entry. As you can see, they break it out 2 separate journal entries basically, but they're really the same transaction. But this portion is the sales revenue and the AR, the accounts receivable. So we're selling it to the customer for $15,000, and then we are getting it off of our books. We don't have this inventory, so the inventory asset reduced to 0. And then the related debit here is for the cost of goods sold expense. And then the revenue minus this expense, that's what becomes our gross profit. Okay, so we talked a little bit about purchase returns, but now that was when we as the merchandiser were the ones returning a product inventory that we had bought. But it's also the case that when we sell things to a buyer, the customers that purchase those can also return them to us. And so when that happens, we're going to use kind of a special account, if you will, or it's a contra revenue account. So we've seen contra asset account with think of accumulated depreciation that reduces that asset. The contra revenue account is going to reduce our revenue. And so sales returns, as I mentioned, it's going to be in the sales return contra asset account. And the reason that we use a contra revenue account is that it allows us to analyze the returns, how much returns there were directly. So if we're keeping the sales revenue and the returns in 2 separate accounts, 2 separate buckets, so that we can do an analysis of sales returns on an ongoing basis and track the returns, see if there's changes in those that might be something we need to be aware of. So it just helps us better understand and have better transparency into the sales returns amounts, as opposed to just reducing the revenue directly when we get a return. So here's an example. Suppose that a customer returned $4,000 worth of undesirable goods to us. The original cost of the inventory was $3,000. So you're basically going to exactly reverse this typical sales entry. So the 4-line, AR, sales revenue, cost of goods sold, inventory. You're going to reverse that entry. So here we can see cost of goods sold reversed, merchandise inventory going back up. This means, the inventory came back to us. We don't have an expense for selling it because it came back. The AR goes down, so we don't have a receivable anymore because the customer returned the items. They're not going to pay us for them. And then the only thing that we do is we don't debit sales revenue. Like we don't exactly reverse these 4 lines because this is not debited to reverse it. Instead, we debit this contra revenue account, sales returns and allowances. And so you can kind of see where that sits here on the income statement, is that contra revenue account has its own little spot. And like I mentioned before, having this contra revenue account allows us to compare directly just to analyze the returns by themselves without directly combining those returns into revenue. So then we can see if returns have gone up a lot. It just gives us more visibility from an accounting and business analysis side. Okay, so in some circumstances, we already talked about purchase allowances, but we can also provide an allowance to a customer if they make a purchase and something they don't something's wrong with it, for example, and we want them to still keep the goods, but we want to somehow compensate them for the fact that the product was damaged, or whatever the incident is, or the circumstances around that inventory that makes it not what they thought they were going to get, for example. So here we've got this example that says if our customer accepted an order and the products were damaged, for instance, damaged during shipping, and we say, hey, if you can just keep those items, we'll give you a 5% discount, if you do. So the customer agrees. They keep $11,000. Let's see, so they returned 4,000. So we're kind of combining this here. So they sent back 4,000 and kept the 11,000. So they're going to get a 5% discount on that 11,000. And so we just multiply 11,000 times 5%. And then we again use that contra revenue account, and we debit that for 550. That'll reduce our sales revenue. And then we just reduce the accounts receivable because they're not going to pay us that portion. That's what we're saying to them, is you don't have to pay us the full amount due that you originally were going to. You can take 5% off of that, essentially. So you can pay us 95% of the original agreed upon price. Okay, and then in addition to, we saw purchase, we as the company could take purchase allowances. We can give sales allowances, and similarly with the discounts, the 210 net 30 type thing, we can offer discounts to our customers as well. And it's a very similar process as us taking a discount. But in terms of the terminology here, 210 net 30, no difference with how you kind of read or understand this. And we're saying as long as our customers pay us within 10 days, we'll give them a 2% discount. Okay. So let's say our customer owed us $10,450, and the customer made the payment within the necessary time frame. So it was purchased on the 15th, paid on the 20th, so it paid within 5 days. That's within the 10-day period. So they get a 2% discount. And the way that we account for that, the AR goes away completely. The original amount that we agreed upon is gone. So we want to reduce accounts receivable for that full balance. But then the cash that we're going to receive is going to be less. So it's going to be only 98%, again, with the 2% discount. So 98% of the $10,450 is actually paid. And then we debit the rest to make this balance to this contra revenue account, again, of sales discounts. So it's a contra revenue account. It reduces our gross profit, essentially. But it's within we're offering this intentionally in order to incentivize faster payment so that we have more cash flow coming in, and that helps our business. So that's why we offer the discounts there. And then alternatively, this is what it looks like from a discount perspective. But if we had no discount, then there would just be no discount, sales discount line item here, and it would just be the full amount of cash received. So that's just the basic kind of cash and AR receipt journal entry that we've been looking at throughout the whole semester. Okay, so now we've got a little question here. If a company sells a product on account, accounts receivable will be credited. So remember, when we sell a product, initially accounts receivable is going to be debited to increase it. And then once we receive payment, then it will be credited. So it's false because at the point of sale, it's increased, and it will only be decreased with a credit later when the payment is actually made. Okay, so we've got payment terms shown as 210 net 20. The purchase was on May 1st. On which date does the discount expire? So basically, you've got 10 days plus the date of the purchase would be May 11th. So on May 12th, that's when you would no longer have a discount if you wait until the 12th. But any payment made between May 1st and May 11th would receive the discount. Okay, true or false? When a customer returns a product, an entry to cost of goods sold is not required. That is false. We're going to reduce cost of goods sold by the amount of the inventory returned because it's no longer sold. It was sold, but now it came back, so we just reverse that cost of goods sold. An invoice in the amount of $100 is dated April 1st with payment terms to 15 net 25. And so if it's paid on April 20th, what is the total discount? So here we could say the discount to receive it, it has to be paid by the 17th. Here we've got payment, add 15 to the initial date of the 1st. So the payment dates could be, as long as it's paid between the 1st and the 16th. But if it's paid on the 20th, there's going to be no discount then because it's too far out from the purchase date. Okay, let's talk a little bit about gross profit margin. So gross profit margin, and we've talked about gross profit so far in this chapter, that being the difference between our sales revenue and our cost of goods sold, and that's net sales revenue. Remember, taking into account those sales returns and sales discounts. So gross profit margin is basically just a ratio then using that concept of gross profit. So we take gross profit and so again, gross profit being the revenue minus cost of goods sold. So like the actual profit that the business makes after accounting for the cost of the inventory. And then we divide that by net sales. So here's an example. If we had sales revenue of 100,000, COGS of 60,000, the gross profit is 40,000. And so here we can see 40,000 divided by 100,000 in sales revenue times 100 to give us a percentage, and that gives us 40%. So we're basically saying that, as you can kind of see, for every dollar of sales revenue that our company A has, we kept 40% of that sales revenue, compared, because the other 60% went to the cost of actually purchasing that inventory in the first place. And then this one's just having us compare to another company. And so this company had 175,000 gross profit on 500,000 sales. So that even though the sales revenue can be higher and all this kind of stuff, we can do the same math on that and see that in this instance, company B is only keeping 35%. So every dollar of sales to the customer, they keep 35% as profit after accounting for the cost of the goods sold. And so the results here, we could say company A is more efficient, basically, if they're selling like the exact same products, I guess, and all that. So it's tricky doing a direct comparison, but this can be really valuable, even just analyzing your own company against prior periods or against the budget or expectations, because that can really show you whether your cost of goods sold is meeting, expectations as well as the sales revenue. So here, this just requires us to do a little bit of math, and so we would have to take our gross profit divided by revenue. So here you can see on $1 million, we're keeping 200,000. So is that 20%? And then here we're keeping 300,000 on 2 million. And so 20% versus 15%, I'm just dividing these out. And so we're generating more gross profit dollars per sales dollar here for the EK Skyline. So that's favorable. You want to keep as much profit as you can, as a business, basically, right? Okay, let's talk a little bit about the multi-step income statement. We've talked about the classified balance sheet previously, and that was a balance sheet that had a division between current assets and non-current assets, and also non-current and current liabilities. And so it's a little bit more of a, you kind of have the basic balance sheet and then the classified balance sheet, more detailed. Similarly with the income statement, we've got kind of the basic income statement where we started out in the course just revenues minus expenses. But here we've got the more detailed multi-step income statement. And with this multi-step income statement, we're going to differentiate between operating and non-operating activities. And so here you can see, and we have our own, as a merchandiser, we're going to have a section that calculates gross profit. So we have our net sales, our gross sales, so all of the sales revenue to customers. We're going to reduce those by the contra revenue accounts of sales returns and discounts and allowances. So that brings down our sales because those are returns or discounts we gave. That gives us net sales. Then we back out the cost of goods sold that we incurred, to sell these products, and that leaves us with gross profit, $94,000 in this example. And then down here on the operating expense section, we classify the expenses, with our multi-step income statement into categories. We have selling expenses here, so all the things related to sales and stores and retail space, etc. And then we have administrative expenses, which is everything related to the office equipment, salaries for the office workers, so on and so forth. And then we've also got a section for non-operating activities like interest revenue or interest expense. That is revenue and expenses that we earn and incur, but that are not specifically related to the direct, mission or of the business. If we're a tool selling company, we might earn some interest revenue and pay some interest expense, but we classify those in a separate section just because they're kind of outside of the operations of the primary operations of the business. Okay, so question here, which line item is included in a multi-step income statement, but not in traditional single-step income statement? So remember, revenue is in a traditional, net income is in a traditional, but gross profit is the new section where we calculate that out. Okay, let's talk about closing entries a little bit. We already talked about closing entries for a service business. And basically the idea of temporary accounts and permanent accounts and closing entries are essentially the same between the different types of businesses. And the only thing that we want to add here to a merchandising business is the idea of us needing to actually go out and do physical inventory counts. So there's all these sales happening and returns and all this kind of stuff. And you as the accountant might have, in your records, you have an idea of what the value of inventory should be and how many inventory items you have and all that kind of stuff. But it is a best practice to go out and actually do a physical inventory account of the actual inventory to ensure that your records are accurate. So here we'll do, and if it's not accurate, then we need to make an adjustment. And in our example that it shows here, you're assuming that whoever it is that's doing these counts goes out and does their month-end count or whenever the end of the reporting period, and they count and they say, oh, you know what? There's $200 less than we thought for some reason. We don't know exactly why in this problem, but our records, there was an error somewhere that happened. So when we actually count, we don't want to have inventory. No, we want our inventory number on the balance sheet that we're saying we own to actually match the inventory that we go out and physically see and touch and count here. Maybe don't touch it, but we physically see it, to ensure that our records are accurate. Here we're saying we're not accurate by $200. So we reduce inventory down to actually reflect the physical count. And we debit the cost of goods sold expense as just the other side of that entry to account for the fact that that inventory is gone. And so we want to keep an eye on that too. That is something where we make this adjustment, but us as accountants would want to track our accuracy every time we have a physical inventory count. And if that count is constantly wrong or getting more wrong or has large differences, it's definitely something you'd want to investigate and try and get to the bottom of why the system is not accurately capturing. But with so much inventory going in and out for a busy business, there are minor issues that can arise because, as you can imagine, there's a lot of processes and people that are constantly going. And in that, sometimes inventory tracking can get a little messed up. Okay, so that, again, that's just an extra little step related to the end of the period for a merchandiser. We've got this adjusted trial balance, so we've already seen this. It's capturing all of our adjusting entries. It's the ending balances for all of our accounts. We have a few new accounts now. We have these contra revenue accounts of sales discounts and returns and allowances. We've got cost of goods sold as an expense account. We've got sales revenue instead of service revenue and all that kind of thing. But despite the differences or new accounts, we're closing everything down the exact same way. We're going to use the income summary method here. We're going to debit our revenues and here, they're credits to begin. So we're just going to debit them to go to zero, put it in the income summary, do the same thing with all of our expenses, including the new and our contra revenue accounts, I should say. So those are, a few new ones. That all closes into the income summary. Then we close the income summary into capital, and then capital gets updated. So this is the exact same process that we followed previously when we learned about closing entries. So nothing really new there. It's just, reminding us of that process and reminding us that there's a few new accounts that will need to be closed. But it's the same exact overall methodology of just taking all of these temporary accounts, anything on the income statement, as well as withdrawals, and bringing those all to zero and basically closing those into capital at the end of the period, and then rolling that forward to the next month and starting over again, just like we learned previously with closing entries. Okay, so here our question says, if the physical count of inventory is less than the records, which account is debited in order to adjust inventory to match the physical count? And that's where we're going to credit inventory if it's less, and we're going to debit cost of goods sold. So that's our debit. And which account is the income summary account closed to? Just like it was previously, nothing changed there. Owner's capital. That's the whole point of doing the closing entries. Okay, let's talk a little bit about internal controls related to inventory. Very important, when you have inventory that you're protecting it, from being damaged or being stolen or anything like that. One of the controls that we already talked about was that month end or period end physical count. That's really important to do so we can actually verify on a regular basis that the inventory hasn't been stolen or some error isn't happened, for example. And so we have some, it is, this was, again, that, these internal controls, as I mentioned in previous discussions about internal controls, it's not, it involves the whole company. So the warehouse team and others in that capacity are going to be kind of charged with maintaining these internal controls. But the accounting department is there because we are the ones with the costs and the units and analyzing the accounting records, etc. And so it's really kind of a dual effort. And we should have plans, policies, procedures, adherence to laws and regulations, all those types of things in place. So again, probably as the accountant, maybe if you're a entry-level staff accountant, you're not going to do any of this. But as you move up the chain, maybe you're the controller or the CFO, you will want to at least collaborate with someone in the warehouse who oversees that side of the business to ensure that the policies and plans and everything in place is as it should be. Safeguarding inventory obviously is really important. You should have locks. You should have just methods in place to ensure that the inventory is not damaged. Make sure that if it's a food manufacturing place, or if you're a merchandiser even that's selling something like food, etc., maybe you have to have the employees wearing a hairnet or coats or something like that. We want to make sure from an internal controls perspective that we have enough inventory on hand, but not too much. So that's an important goal, and we can have some systems in place to ensure that happens. And again, like I mentioned, it's a total team effort. It involves all the departments that touch inventory and track it, and kind of a business-wide effort there. Which of the following is not a good inventory control? Overstating inventory. That's probably a result of no controls, essentially. Okay, with that said, we're going to wrap up our lecture here and summarize the topics that we discussed in this chapter, with the beginning of just having a definition of what a merchandising business is, or merchandiser, or like I mentioned, you might have heard the term retailer. Some of you might work in retail, working for a business that sells something, maybe a clothing store, for example, or something to that effect. So a merchandising business, it's any business that buys and sells products for the purpose of making a profit. And we have inventory now, we have cost of goods sold, some new accounting we need to account for. We should understand the differences between the perpetual and the periodic systems. The perpetual system is more ideal. It provides constant updates every time a sale and a purchase is made. And it's more so the type of system that we will consider when we're doing our homework and our test problems, etc. But you should know that there is another style. It's not as timely, but it's less expensive to implement, and that would be the periodic inventory system. We had a whole list of different types of journal entries related to inventory purchases and sales. We learned about the concepts of FOB shipping point and FOB destination, and the reflection of who pays the shipping cost and when the ownership changes hands, whether either that's at the shipping point where the buyer now owns it while it's being shipped, or destination where the seller continues to own the inventory until it arrives at the destination. We looked at a lot of the journal entries related, again, so this is the purchases and sales. There's quite a lot of journal entries here related to inventory and all of the purchases and sales that can occur. I know it can feel a little overwhelming. Again, we just touch on this in the lecture here, but we're going to spend most of our time when we're doing our exercises and homework and test problems and all that here in this chapter for these concepts related to the journal entries and all that. So we'll have plenty of time to practice those, and hopefully they'll become a little more familiar as we go through. We talked about the concept of gross profit and gross profit margin. And remember that gross profit is just the amount of profit that remains after you deduct the cost of goods sold from the sales revenue. And the gross profit margin is just us dividing the gross profit by the total sales revenue so that we can understand what proportion of a sale are we actually keeping as profit when we account for the fact that we had to buy that inventory in the first place. We also talked about the multi-step income statement and saw how we have sections for calculation of gross profit. We have calculations, or I should say certain separated sections in our income statement for sales, for admin, and for other. So it's a more detailed income statement. It still produces net income, net loss, just like our basic income statement does, but it organizes the information into some new categories. We talked about the closing entries for a merchandising business and them being exactly the same basically as the closing entries that we learned about previously, where temporary accounts are all closed into equity or capital, the temporary accounts being everything on the income statement and withdrawals. So all the revenues, expenses, contra revenues, remember those, that's kind of a new one for this chapter as well. So all of those get closed. And the only additional concept we talked about in this class, in this chapter, I should say, is the concept of needing to do a physical inventory count at the end of the period to ensure that the accounting records actually reflect the inventory that is on hand. And that led us into a conversation about inventory controls, the physical inventory count being an extremely important part of internal controls for a merchandising business or any business that has inventory, basically. And we also just talked about some of the concepts where having appropriate policies and procedures and all that in place is important to maintain compliance and safety and accuracy and reduce errors, reduce risks, all those kind of things. And for a merchandising business, especially a larger one, some of this really is it can be like a safety issue. You know, when you have a large warehouse full of heavy inventory, for example, or just lots of inventory, when you pile it all together, it gets pretty heavy. Maybe people are driving around in forklifts and all those kind of things. It becomes really important, you know, maybe compared to a service business, to, you know, when you have that kind of merchandising business with products that you're managing, you really have to be adhering to laws and regulations, making sure that your warehouse is safe and that people aren't in danger, et cetera, and have all those appropriate internal controls in place. So again, as I've mentioned previously, it's not just a number crunching exercise when it comes to inventory or any internal controls. It's really more of a broad-based best practices type of scenario that involves all of the departments and employees working together to ensure that the inventory is protected, that the people that work there are safe, that the accounting records are being updated like they should be, all those kind of topics. So that's a very broad reaching, real world type of concept that maybe someday you all will be confronted with. But here we're just introducing that idea that you as the accountant play a key role in a merchandising business, but it is really a business-wide undertaking to ensure that inventory is protected, accounted for correctly, that the processes work as they're supposed to, that safety is a top consideration for employees in the warehouse, and all those kind of ideas. Okay, that basically brings us to the end of the chapter. We have some extra appendices here that talk more about the periodic inventory system, but we're going to skip over those for now. Like I said, we're going to really primarily focus on the perpetual inventory system. And as far as understanding the periodic inventory system, just knowing the basic differences like we talked about in this lecture so far is going to be sufficient for answering maybe a multiple choice question that asks about the difference in the two systems. But the work exercises that you'll have to do, whether that's in homework or on a test, are going to be focused primarily on the perpetual system that we discussed. So with that said, I'm going to wrap up our lecture here. Thanks for following along. Hope everyone is doing great, and I will talk to you soon. All right, bye everybody.